Hello, welcome back guys, hope your weekend was nice. In this video we are taking a look at Meta. It's been a little while since we last talked about the company and a few things have happened. Now first of all, if you will notice that back in January, like at the end of January, the stock was near $150, 153. Then it started going higher and higher and higher. It had a pretty awesome earnings report and continued going upwards, currently sitting at 185 bucks on its way to going back to 200. Now 237 is the 1 year high, so it's not that far from that. It's like 22% down. But if you take a look at the 3 year chart, you can kind of see that the company was almost at 400 bucks at some point. And so there is a lot of, a lot of road ahead to reach that level again. But what is the company doing right now? Why is it up? Like you can kind of see the recent trend, it's going upwards. We're going to talk a little bit about the company, the financials, and also what's the price to potentially buy. Now, I myself already own Meta. My cost basis is around 158, and I bought it like 3 years ago or so, back in the Cambridge Analytica scandal. But in the meantime, it has been going up and down, and mainly down at the recent overall stock market crash, I should say. Now, what is going on with Meta? Let's take a look at some important things. Now, Meta is slashing up to $500 off the price of its VR headsets after underwhelming sales and mixed reviews. And this is something obviously pretty important because the VR headset is already pretty expensive. And given the fact that the metaverse and the whole virtual world that they have created, it's not so appealing to people. It's good that they're actually cutting some of the price. Maybe they will take a little bit of a hit at the operating expenses, but the thing is, you want to attract more and more people here. So the underwhelming sales make a lot of sense for that fact to actually cut down on the pricing. Now, Pro says buy Meta stock after it lowered price of its VR headsets. You can kind of see here that this was met with some positive remarks from people and professionals in this case. And so Meta stock is actually already up about 50% versus the start of the year. Again, if you take a look at the start of the year, 2023, you can kind of see that it has been going upwards and upwards, about 127. So yeah, it's about 50%. It was even lower at some point. And over here in this article. Yeah, is Meta stock worth buying now? Is what somebody is asking here. The article is asking. And the fact that Meta is actually seemingly prioritizing cash flow again, not spending as much as they used to spend in the past couple of years due to the metaverse. You can kind of see here that almost 14 billion of a loss to Reality Labs is insane. And so the fact that they're cutting down on these kinds of expenses a little bit is already a very, very positive sign. Now, there are some other positive signs as well, like the fact that after losing billions of dollars on the metaverse, the thing that we talked about, Mark Zuckerberg's launching a top level team at Meta to develop AI products. When this became known, the stock actually skyrocketed that day to develop AI products for WhatsApp, Messenger, and Instagram. Nowadays, AI is all the jazz, I suppose. You know, everybody's talking about AI with what has happened with Google, for example, and Microsoft, and pretty much GPT. Everybody is actually looking to utilize AI for all sorts of purposes. We have already talked about it in terms of the search engines, again, like Google and the likes. But now we're looking at Meta potentially getting something after ChatGPT, pretty much utilizing this kind of technology to make a better metaverse, as they have lost a lot of tons of money trying to find pretty much the best way to make it popular for people. But it hasn't happened yet, and they are continuously, relentlessly pursuing that at the moment. You can kind of see what they are looking at. Mark Zuckerberg said that they're creating a new top-level product group at Meta focused on generative AI to turbocharge their work in this area. We're starting by pulling together a lot of the teams working on generative AI across the company into one group focused on building delightful experiences around this technology, which is very, very important. Delightful experiences is key, because if people are going to be using these VR headsets and actually having the fuss to actually wear this thing and maybe even potentially get a headache, I don't know, I'm not a big fan of this kind of technology, they will have to get a lot out of it. They will have to get some very, very nice experiences. So I'm glad to hear this is a key phrase here, building delightful experiences. I hope they will actually manage to do that. Now, one thing here, I was reading an article about Meta, and the author claims that he doesn't think that Meta knows it's a game company. And this is very true. And this is what I wanted to point out in regards to the metaverse and what Facebook is doing right now. It's extremely important to make sure that you are creating these kinds of experiences that are very positive and very nice for people that are going to be utilizing the headsets. Because, again, not many people are going to be using this when they are working, for example. It doesn't make a ton of sense. But if you want to play, if you want to gain some entertainment out of it, and if they find sort of like a nice way to do that, metaverse that is, that would be a very, very huge win. And the fact that they are, kind of lowering the price is a start. But the experience that they have created, and this is what the article is talking about here, the fact that the Horizon World is so bad that even the people who make it don't want to use it. Again, we have talked about it in the past. People were not so keen on using Horizon World, even the employees. So that's a very, very bad sign. You want to make it be really, really nice, be a great experience, because otherwise people don't have any reason to use that, is the thing. Now, amidst all that, the stock has been going up, and this is the nice thing. And it's already pretty cheap. Again, you can kind of see how the stock price has been going down. But while the price is lower than what it used to be, is it cheap enough to buy is always the question. And this is where we actually take a look at the financials. Now, the P ratio and the price to free cash flow is slightly elevated from what it used to be because obviously the stock price has been going a little bit higher, but still it's at a very, very nice range, 21 and 25. Again, remember, for a software company of this sort, it used to be lower. Now, Meta and most companies had a little bit of a trouble with their net income and all that. Not so much Meta, but generally speaking, companies have been having troubles with their free cash flow lately, with their net income, because the whole stock market has been going down, the whole economy has been going down during the past couple of years. So you can kind of excuse them for that for a little while. But overall, you can kind of see that this is a pretty nice picture in terms of the P ratio and price to free cash flow for the company. And the fact that it is red doesn't mean much here, because it becomes red after it's 20. But it really depends on the company, or what the company is overall doing. And we're going to examine our discounted cash flow model to examine that in more detail. Now, the outstanding shares going down, and the company keeps buying more and more. We know about that. And they don't have any liabilities, no debt here for the company. It's pretty much a debt-free company that has a ton of money in its coffers. Very, very important. With the revenue growing, the net income, again, staggering a little bit, but overall growing nicely. And the free cash flow growing, total equity growth also high over here. And that's because of the company pretty much generating more wealth, and not the fact that they are printing shares. They're not doing that. They're actually buying back shares. So they're actually utilizing their equity to buy back shares. So this is very nice as an overall picture. Now, again, they have spent tons in the metaverse, and that's the big problem with the company. But overall, the company is making tons of money, and this is the most important thing for the long run. And the margins over here, about 20% right now, they're getting slightly better, I believe, but they used to be even better. So that's something to recognize over here. Now, we can take a little bit of a look at the financial statements, and it kind of points us to the story of the company, what they have been doing from 55 billion to 116. This is pretty amazing here, growing their revenues at a very, very nice pace. And the net income from 22 billion to 23 over here. Again, they had a little bit of a loss, a decline. But overall, again, they are doing pretty greatly. Like 40 billion was what happened last year. We did expect this decline for the net income in the latest fiscal year. In terms of the balance sheet of the company, you can see here the total equity going up 84 billion to 126. And even though the company had a little bit of a decline in their overall operations, their total equity is still going up. And again, as they are still also buying back shares, which is nice to see. Now, what about the cash flow? The cash flow, as you'll see here, starts from the net income, and then we add back all the non-cash expenditures here. And you will see that the net cash from operating activities, operating cash flow, is sitting at 50 billion, where it used to be almost 57, 58 over here back in the previous fiscal year, but still going upwards from what the company has been doing, and quite a lot, actually. You can kind of see that here in the operating cash flow. And the free cash flow from 15 billion to 19 billion, and in the meantime, there was also 40. And this has a lot to do, obviously, with the capital expenditures. We know about this. Take a look at this one, 31 billion here. Amazing expenses here. We know about this, though, Reality Labs and all that stuff. A lot of capital expenditures. The company has been trying to reinvent themselves, sort of, and this has cost them a lot of free cash flow. But again, the fact that the company can generate this cash flow, this operating cash flow, let's just say, is very, very important, because the capital expenditures at some point will stop. whether the company will actually be able to make money out of this investment or eventually just drop it. But still, the operating cash flow will remain. It's going to be at similar levels. So this is a very, very important thing in this case. The free cash flow is obviously very, very important, but if capital expenditures happen for a reason, it's not a big deal. You can take a loss of like a couple of years or so. They shouldn't overdo it though, because it can pretty much accumulate over the long run, these kinds of losses if they continue. Now, at the very end of the video, we always take a look at our free cash flow model just to discover what kind of price to pay for the company. You can kind of see here in our handy little table. Obviously, all our Patreons have access to the tool over here that I'm using, so you can become a Patreon. You can find a link in the description box below this video if you're interested, and you pretty much use everything that we have in this tool, and a lot of things going around. And you will see here that you get a handy little table with the revenue, net income, free cash flow, and everything. And what happened with the averages, the 5-year average, the 3-year average, so very, very handy so that you can actually utilize it for your projections. So what I'm going to do is I'm gonna assume that the company will not grow at all in the next 5 years, so 0% growth, which is obviously not going to happen. I mean, the company will grow some. You may have maybe a year or two where the growth may be even negative, but for the next 5 years, it's very unlikely that the company will have a 0% revenue growth. Maybe something like 5% makes more sense, or even 10% in some situations. The company is still growing nicely, and you will see that the 3-year average is 20%, and it's only last year that they went sideways, or they went almost negative here. And net income margins, again, they have been going down lately, something that is also understandable. And we do expect this to be higher in the upcoming 5 years. Now, again, we may have a couple of years of lesser net income margins. So for this reason, I'm going to go 20% for the low ones, which I think they're going to easily surpass it, frankly, eventually. Then 24 and 28, which I think is more likely in the long run, because again, remember, this is a software company, right? So they're selling advertising. So high margins is what this means. And free cash flow margin, about 90% is what they typically make. 90, 100, very normal. 80, 90, and 100 is what I'm going to use. An annual return of 13% is the typical one that I like to utilize. You hit calculate, and you see that with these projections, where obviously this revenue growth is at 0%, we are going to be in the red. And the net income margin, again, 20%, the free cash flow margin, 80%. So basically, the company is staying where it is right now. This is why this is so low. Now, for the 5% growth for the company, then we're getting at $157, $58. And remember that currently we're sitting at 185. And the high margins, the high revenue growth, which is 10%, then we're looking at $251. So I wanted to do this exercise so that you see what kind of different scenarios we get with these projections. Now, will we get 0% revenue growth for the next 5 years? It's almost impossible for it to happen. 5% is, I guess, possible. I guess it's a possibility. But again, I think that more than likely we're going to be a little bit higher. So frankly, what I think is a little bit more normal in terms of projections here would probably be something like 5, 10, and 15%, frankly. Again, based on the company's history and based on what they have been doing, you can kind of see that overall their growth has been tremendous. So again, I use this so that you see what kind of differential we're getting here. But if we hit calculate with these kinds of projections, which make obviously more sense, then you are looking at a medium of almost $200 and a high of $300. And the low is 116. Again, this has a lot to do with the net income margin, obviously, because it's profitability, and we go much, much lower here for the first kind of projections here, the very, very, very conservative ones. But even then, you have to also recognize that the company has other very, very important things for themselves. The fact that they have no debt, obviously, the fact that they are buying back shares, they have fantastic margins, they are a household name. All of these things matter a ton. And so even if you go with your lowest projections and you get something that is red, it could still be a potential buy. Now, I think this company is definitely a buy at this level, even at the 185 for the long run. Although, it's getting a little bit more expensive, but still, I think it's a fantastic opportunity and a fantastic company to hold again for the long run is what I think about Meta. But do tell me what you think about Facebook, Meta. What do you think about their AI advancements? Do you think they're going to be doing well? And leave a comment below. I'd love to hear your opinion. And thank you for watching again, guys, and I'll see you soon. Bye-bye.